Defense contractors are finding it harder and harder to make a profit these days. With budget cuts and sequestration having no end in sight, defense contractors need to fight tooth and nail to win lucrative federal contracts. VSE Corporation is no exception. While they maintain a firm foothold in several government functions and processes, they are still vulnerable to federally mandated budget cuts. In the world of government contracting, stability is a pipe dream. Therefore, companies like VSE have to devise ways to stay relevant with the times and continue adding value to their services. My name is Nicholas Pender, and in this presentation, we're going to look at VSE's solvency and profitability. By assessing these two aspects of the company, we'll be able to gauge how well VSE can invest back into itself and stay relevant in this extremely competitive market. Before we get started, I'd like to provide some of my background information as it pertains to this study. Specifically, I have 2 years of experience working with VSE Corp. From 2012 to 2014, I managed a $300 million War Reserve material program on Andersen Air Force Base, Guam, and VSE Corp was the primary contractor hired for maintenance and sustainment of our largest portion of WRM, the Basic Expeditionary Airfield Resources, also known as BEAR. Management of this program involved devising the annual WRM budget, monitoring the contractor for effectiveness, and allocating WRM funds appropriately for maintenance and acquisition of assets. I'm currently a student at Bellevue University, enrolled in the Supply Chain and Logistics Management Bachelor's of Science program. This financial presentation on VSE Corp is part of the assigned curriculum. In today's agenda, we're going to cover some of the background information of VSE Corporation. We'll define the solvency ratios, then assess the solvency of VSE using those ratios to measure their ability to pay off their debts and stay out of the red. Next, we'll define the probability ratios, then get an understanding of VSE's profitability using the ratios to project these findings as well. In each of these ratio assessments, we'll bump VSE's numbers with those of similar industries to see how well VSE stacks up against them. After that, we'll take a comprehensive look at what these ratios are telling us and uncover the root causes driving these numbers. This will allow us to fully realize VSE's capability for self-investment and long-range potential. Finally, I'll provide a summary of what we've covered, and there will be an opportunity for questions at the end. VSE Corporation was founded in 1959 as Value Engineering Company. Originally focused on sustainment of DoD legacy systems, their primary mission was sustainment and refurbishment of existing military equipment and vehicles. They have expanded into other professional industries such as supply chain management, aviation, and IT services. VSE is now a full-service federal contractor whose customers include the Army, Navy, Air Force, and even other non-DoD federal entities such as the U.S. Postal Service and the U.S. Department of Treasury. They also provide services to friendly nations such as India and Saudi Arabia. Solvency is basically a company's ability to pay off its debts. Here, we use 4 ratios as a way to determine the various aspects of debt. The current ratio is used to measure a company's ability to pay off current liabilities with current assets. This is calculated by dividing a company's current assets by its current liabilities. The quick ratio measures the ability to pay all current liabilities if they were to become due immediately. It's calculated by adding cash, short-term investments, and net current receivables, then dividing the sum by current liabilities. The most desirable number for a quick ratio is the ratio of 1.0. The debt ratio measures the proportion of a company's assets financed with debt. It's measured by taking the company's total liabilities and dividing them by its total assets. A good rule of thumb here is anything lower than 0.6 or 60% of a company's assets financed with debt. Finally, times interest earned. It's the ratio we use to see how many times operating income can cover the interest on the company's debt. To get this, we divide the income from operations by the interest expense. Now, let's move on to crunching the numbers. So, to start off, we'll look at VSE's current ratio. Taking their total assets of $122,368,000 and dividing it by their current liabilities of of $87,497,000, we get a ratio of 1.39. That's not too far off from the aerospace defense industry average of 1.43, so it's safe to say VSE is doing just fine in this category. Next, VSE's quick ratio. Now for this, VSE has stated in their 10K report that short-term, or as they put it, short maturation investments are factored into their cash and cash equivalents. Therefore, for this calculation, we're only adding $263,000 of cash and cash equivalents to $59,391,000 in net current receivables. Dividing this sum by current liabilities of $87,497,000, we get a quick ratio of 0.682, well below the recommended 1.0 limit. However, much better than the industry average of 0.33. Moving on to the debt ratio, we took the total liabilities of $149,841,000 and divided it by $355,330,000 in total assets, with a return ratio of 0.42 or 42%. This means 42% of the company is owned by creditors and 58% is owned by the shareholders. This is a very ideal situation, far below the 60% recommended limit of debt. Our final solvency measurement tool is the times interest earned ratio. Taking VSE's operating income of $36,930,000 and dividing it by their net interest expense of $3,983,000, we get a ratio of 9.27. This means that VSE can pay off its interest as it comes due 9.27 times over. While this is an excellent figure, it falls very far below the industry average of 20.32. Profitability is the company's ability to earn a surplus of income, that is, profit, which can be invested back into the business. As with solvency, we use ratios to measure a company's profitability. Specifically, there are 4 ratios we use. The net profit margin, also called the rate of return on net sales, measures percentage of each dollar that is earned as net income. We divide net income by net sales or revenue to get this ratio. Next, gross margin is measured by subtracting the cost of goods sold by the revenue, then dividing the remainder by the revenue. This figure is important in seeing the percent of the total revenues retained after direct operating costs. A larger percentage means a larger amount of retained revenues. Another ratio we use is the operating margin. It's important in determining the percentage of revenue remaining after costs such as wages and raw materials have been paid. We calculate this by dividing operating income by the revenue. Finally, let's take a look at the pre-tax margin. The pre-tax margin is used to determine a company's earnings before tax. It's measured as a percentage, the higher the better, and calculated by dividing pre-tax earnings by the revenue. Now, let's take a look at the numbers. Before we get started, I must state that these numbers are 5-year averages, as this was the only way Factiva.com presented the data. Now, looking at the numbers, we can see that VSE has a net profit margin of 4.04%, a rather low figure despite being a couple percentage points lower than the industry average of 6.77%. VSE's gross margin came out at 10.83%, nearly half that of the industry average of 21.7%. Clearly, VSE has some room for improvement in terms of efficiently providing services to its customers. Next is the operating margin. VSE's 5-year average came in at 7.38%, while the industry's average sat at 11.31%. Again, VSE could do some trimming down on their costs. Finally, a look at VSE's pre-tax margin reflects a 6.47% 5-year average, while the industry average sits at 3 percentage points higher at 9.8%. VSE's revenue for 2014 was $424,071,000. Therefore, when multiplying the average ratio by VSE's revenue, you can see those few percentage points equate to $14,121,564 less than what VSE could be taking home if they push closer to the industry average. Overall, VSE fares better than most at paying off their debts. However, They appear to struggle at increasing their profits when compared to the industry average. There has certainly been a declination in VSE's revenues ever since the drawdown of the Iraq War, which may have something to do with VSE's profitability staggering as of late. They've shown aggressive behavior in the past couple of years, recently making acquisitions outside their historical profession of legacy systems sustainment. Perhaps these acquisitions of supply chain, IT, and aviation companies are cutting into profits more than they anticipated, and they're now going through the growing pains of reshaping their business. This is at least my take when looking at the numbers. Their existing federal contracts are keeping them afloat and able to pay off their debts, but for how long? VSE needs to proceed with caution when making large acquisitions in unfamiliar territory. In conclusion, we went over some of the background of VSE Corporation. We defined the solvency ratios, then assessed the solvency of VSE, using those ratios to measure their ability to pay off their debts and stay out of the red. Then we defined the probability ratios and used them to gain an understanding of VSE's profitability. In each of these ratio assessments, we bumped VSE's numbers with those of similar industries to see how well VSE stacked up against them. After that, we took a comprehensive look at these ratios, at what these ratios may be telling us, and uncovered some possible root causes driving the numbers. This allowed us to fully realize VSE's capability for self-investment and what they need to do to stay successful in the long term. If anyone has any questions, you may present them now.